We want to tell the story of the macro through the micro. Can you do that with Shinali's banks this morning? Can you look at Wells Fargo, at JP Morgan, at Citi, and tell the story of this economy?
Well, you can if you actually look. So they're basically telling you, on a broad sense, that business is still good, okay? Yeah, we're worried about net interest margins and so on, but the flip side of that is we still haven't had a capital market cycle. So we've got that to look forward to. That's the backdrop. But when you look at it, it is the story of what we've seen for several quarters in a row in terms of earnings. One stock's going one way, the other stock's going the other way, and net, this really reinforces, even though the massive stocks continue to move higher, and we think they do continue to move higher, that it is much more a market of stocks rather than a stock market.
But the funny thing here, coming from an investment banking correspondent, I think this is a funny thing to say, Wall Street isn't enough for me. If these Main Street businesses aren't really driving forward, if consumers are perhaps maxed out on credit cards, how much steam is there left in a consumer that is still feeling the pinch of higher rates? So
I think what you're seeing, again, is trade down in various areas. But in the final analysis, we think that there's plenty of liquidity out there. We also think, look, yesterday's number, it's no coincidence that yesterday's CPI sort of calmed the bond market, and today's PPI is the bond market is trying to sort of digest that in another way, because what we know is that the Fed is there, and it's not necessarily that the Fed put is going to be exercised, but the market feels good, and I think consumers are going to start to feel better about the fact that whether it's inflation moderating or the fact that policy is going to do what it needs to do in response to the incoming data.
I want to talk a little bit about the market action that we saw yesterday, because I think that yesterday was a pretty important day. It was kind of staggering to see the S&P 500 down almost 1%. You take a look at the equal weight index up by more than 1%. I really feel like we learned why concentration cuts on the other side. Is this the start of the great rotation? Do you have any confidence in calling that?
We do. Okay, but from that perspective, though, this isn't a, sell the Mag 7. We think that's one of these things that, you've had such enormous gains in those stocks that a period of digestion is normal. It's actually healthy. It doesn't necessarily need to drag the broad market down, which is what we saw yesterday, which is what we're seeing on the screen this morning. And for us, again, when you think about the long-term prospects of the market in general, you want to see small caps start to participate. Again, to your point a moment ago, Shinali, is like that is more of a ratifying the broader health of Main Street America.
Well, to your point on small caps, the Russell 2000 up, 3.6% yesterday. They were definitely participating in a big way. You did get a note of caution from Wells Fargo this morning, Chris Harvey writing that we believe the great rotation needs lower rates and earnings optimism. Maybe we have the lower rates coming, but when it comes to earnings optimism, are you going to see that broadening out just in the fundamentals of those smaller companies, or do we have to wait a little bit?
So that may take another quarter or two to develop when there's a greater sense of confidence that we are, a recession, perhaps will get pushed off in time, or, furthering the soft landing thesis. But when you think about the small caps and you think about sort of that progression, they're trading at such a compelling relative discount to the S&P 500 that, this is the time for us where you need to start rotating there, and then the earnings come after the move has started.
My buddy Joe Brusuelis writing into the show and says, maybe we get more talk about the possibility of a cut in July. Is that, you just mentioned a Fed put isn't coming necessarily, but could we see it in July already?
It's not likely. Okay, the data hasn't deteriorated. The labor market data hasn't really deteriorated enough. It's one of those ones, again, the Fed doesn't need to. They have the luxury of waiting. And of course, this morning's data certainly is sort of a little bit of a sidetrack on that story. But in general, we do think they're on track for September.
To take the flip side here, when you look at the PPI data this morning, just a little bit of uncertainty, at least a choppy path to September here. What if we don't see that rate cut in September? What would that mean for equities?
Well, so here's the interesting thing. Remember, the story of this year is we started the year off pricing 6.5 cuts this year, and now we're pricing 2, and stocks have just rallied the entire time. It's much less about when the cuts are coming and how they're delivered, and much more about the confidence that the Fed is going to do the right thing. It's ready if the economy starts to turn down, which it has not. The labor market is softening very gradually here. And on the flip side, it's okay. The market is confident that the Fed will be patient if the inflation data unexpectedly starts to...
Do you think the economy isn't turning down? I mean, I was looking at Fastenal earnings this morning, 51 cents on 1.9 billion in revenue. The same quarter last year, 52 cents on 1.9 billion in revenue. And this is a company that, they supply everything to the industrial manufacturing base. The economy looks like it's slowing.
So I guess maybe it's no coincidence, or maybe it's a happy coincidence that we're underweight industrials on the theory that the economy is slowing. But there is definitely a material difference between slowing and negative GDP.
Right.
And we just, to us, where the consternation would set in is if you really see the labor market start to crack. And you look at yesterday's weekly claims, we're not there yet.